Hey, good afternoon and welcome to Sensible Financial Planning's webinar, Tips for Beginners. Tips. I'm Carrie Fristow and I will be your moderator. Today, Sensible Financial's founder, Rick Miller, will talk about tips, which are Treasury Inflation-Protected Securities. Rick Miller holds a PhD in economics from the University of Chicago and started Sensible Financial over 20 years ago. He is also a certified financial planner. You can see all of our past webinars on Sensible Financial's website at sensiblefinancial.com/webinars. You can also register for upcoming webinars through a link in Sensible Financial's newsletter, which we'll publish later this month, or at sensiblefinancial.com/webinars. Again, please submit your questions through the Q&A link. It's at the bottom of your screen. Rick will answer as many questions as he has time for. There'll be two different Q&A sessions, once approximately halfway through the webinar and once at the end. Unfortunately, he can't give personal advice in this setting because there just isn't the time for him to gather the proper context. We will display Rick's contact information at the end of the webinar. And now, Rick, take it away.
Thank you, Carrie, and welcome everyone. Today, we're going to talk about tips and I-bonds for beginners. And just to repeat what Carrie said, if you have questions, please enter them into the chat window. We will take questions twice. I guess it's a Q&A window. We'll take questions twice, once about halfway through and once near the end. So here we go. We're going to start by talking about money. And in particular, we're going to focus on the aspect of money that is buying power. We're going to think about money as buying power. And economists require money to have three attributes in order for it to count as money. It has to be a medium of exchange, something that participants in a market will use to trade. It has to be a unit of account, something that participants will use to track how many resources they have. So if you think about your bank account, you think about the amount of money in the bank account, and you think about what you might be able to buy with that. And finally, it's a store of value, something that participants will use to keep their resources over time. And for money as buying power, predictability is really important. If a participant is expected to accept money as a medium of exchange, they have to believe that they're going to be able to use it themselves in future transactions. If they're going to use it as a unit of account to keep track of their resources, then those resources have to have a reliable value in terms of that unit of account. And finally, to consider something as a store of value, they have to be confident that they'll be able to use that store of value in future transactions. So we're going to be thinking about tips and I-bonds in the context of, or with this idea of predictability in mind. And that's why we're focusing on it at the beginning. To illustrate the notion of a unit of account, you can think about how you use your dollars and how you could think about the money that you have, let's say, in your bank account, in terms of how far it might go toward buying a house or a car or a nice meal. In each case, I suspect that you have a pretty good idea of the value of houses and cars and meals in terms of dollars. So dollars are money. For money to be a good store of value, we have to be confident about how much we'll be able to buy in the future. In 1 year, say for a vacation, in 10 years, say if we're thinking about funding college, or in 30 years, say if we're thinking about funding retirement. And we know that if we just hold cash, we won't be able to buy much more in the future than we could buy today. And therefore, we invest our money into vehicles that promise a higher return, often. Bonds are an example of an investment like that. They're loans, and we name them to reflect who the borrower is. So Treasury bonds issued by the federal government, the federal Treasury. Municipal bonds issued by states and cities. Corporate bonds issued by companies. And bonds come with a promise. The borrowers promise to pay interest and repay the principal. And therefore, we're confident that we're going to get our money back and that we'll have the money that we expect to have when we expect to have it. CDs are a special kind of loan. They're insured by the Federal Deposit Insurance Corporation within limits. Often there's a specified term. So a 1-year CD, a 6-month CD, a 5-year CD. And the interest rate is promised at the outset when you buy it. And we can know how many dollars we'll have at the CD's maturity. So CDs are a particular kind of investment, and we're going to use that as a comparison for the other investments for TIPS and I bonds that we're going to talk about. Now, when we're thinking about money, it's important to think about inflation too, because inflation is a representation of the change in the value of your money. Inflation makes dollars less useful as money because the unit of account is less helpful if it's not stable, and the store of value is less helpful if the value diminishes. We can think about inflation and our experience of inflation quantitatively, and I'm doing that here using 2003 as a starting point. And we can ask, how much does a dollar buy? And the inflation figures tell us, and they're approximate and they vary by the product and service that we're considering, but on average, in 2013, a dollar bought only what 79 cents bought in 2003. That's a decline of 21% in 10 years. And in 2023, a dollar bought only what 60 cents bought in 2003. That's another 23% decline in the second 10 years. So in the 20 years from 2003 to 2023, the dollar bought less and less. There was a 40% decline overall. The math's just a little bit complicated. The 21 and the 23 don't quite add to 40. I promise you I've checked it and it's correct. I'm happy to take that as a question offline if people are interested. So if we think about inflation and the history of inflation, it's quite volatile, and we can see that it was very high early in the last century, and this is roughly the time of World War I. There was more inflation during World War II, and then after World War II, and then again there was significant inflation in the mid 70s and early 80s. And since then, it's been pretty flat. Now, I want to point out that even though this is low and flat here, right? If we look at starting in 2023 and we go to 2013, it doesn't look like inflation was very much. But remember, we said it was 21% cumulatively over that period of time. So even if the rate is low over not that long, 10 years isn't that long, there can be a big decline. But during this period, it seemed as though the government, the Federal Reserve, could manage inflation pretty well. And then in 2021, and I say boom, right? There was a very large increase in inflation. So inflation is a concern for those of us who plan. And as a financial planner, I think we plan, and I'm encouraging people, you to plan as well. So if you're planning, it's important to incorporate inflation in your planning because it has a big impact on the purchasing power of your money. And we're going to go into a little bit more detail now. We're going to think about bread. And I think that bread is a very interesting example here. And here we're looking at the price of bread per pound from, again, 2003 to 2023. And you can see that there was a sort of a pretty rapid increase here. And then the price of bread was pretty flat. And then another rapid increase very recently. Now, let's see what that means in terms of how much bread you can buy. If we're thinking about a pound loaf of bread, in 2003, with $6, you could have bought 6 loaves of bread, 6 one-pound loaves of bread. In between 2008 and 2019, this period here when prices were pretty flat, With $6, you could have bought 5 loaves of bread. But today, that $6 buys only 3 1-pound loaves of bread. So the purchasing power in bread has been cut in half in that 20 years. So that illustrates one of the points that I made, which is that inflation is an average, and some prices go up faster, some prices go up slower. But still, we're concerned about the value of our money, how much it will buy. Cars are another example of the impact of inflation. I looked at Toyota Corolla prices from 2003 to 2023. And I looked at 10-year intervals. I didn't look at prices each month. And the Bureau of Labor Statistics that calculates inflation doesn't publish Toyota prices, Corolla prices on a monthly basis, the way they do with bread prices. And they also do gasoline and a couple of other specific products. But I thought it would be interesting to look at cars. And here we see that in 2003, we could have bought 5 Toyota Corollas with $73,000. And my source here is cargurus.com. So I'm that they're telling us what the initial price was, and I'm relying on them. And we do see that there's a decline in buying power. In 2013, we could only buy 4 with $73,000, and today, 3. So our ability to buy Toyotas or Corollas with dollars has diminished over time. Now, looking at it this way, the decline in car buying power of our money appears to have been fairly steady since 2003. And if prices change slowly and steadily, our understanding of dollars as units of account can kind of keep up with that. So we know what a dollar buys, and we're comfortable. Even if it buys a little less each year, we can adapt. But if we think about the price of bread, again, I'm going to highlight how the price of bread changed, and this is now how much a dollar will buy in terms of how many 1-pound loaves we can buy per dollar. So that sort of reverses the graph that I showed you earlier. But you see that the amount of bread that we could buy per dollar fell pretty quickly from 2003 to 2008, about 6% a year, and that means that our buying power in terms of loaves of bread would have taken about 11 years, if it had kept up at that pace, to fall in half. But then from 2008 to 2016, there was almost no change. And from 2016 to 2019, the purchasing power went up. So it's pretty flat. And you see, again, we've gone from 6 loaves to 5 loaves over that period of time, and then from 5 loaves to 3 very quickly in just 4 years. And I don't know about you, but I noticed that. And people were pretty upset about that rapid inflation. People are still upset about the pace of inflation being faster. So, and they're upset because their money isn't worth what they thought it was worth. And so their confidence, not only are they unhappy that it doesn't go as far, but their confidence in the purchasing power is diminished. Now, when we plan for retirement or for college or even for a vacation next year, it's essential to take account of inflation. And we can plan to spend dollars, but for the plan to work, the dollars have to buy the products and services that we need. And inflation's not fully predictable, unfortunately, but still we plan in dollars. When we plan for clients, we plan in dollars of today, and we strive to ensure that our investments will keep up with inflation. So here we're looking at 10-year intervals from 23 to 33 and so forth. This is the future for a 60-year-old today. They might be planning to retire in 10 years, be mid-retirement in 20 years, later in retirement in 30 years, and at the end of retirement in 40 years, let's say. And we're planning for them to spend in dollars of today about the same amount each year. And we're illustrating that with 1 loaf of bread each year. Of course, there would be many loaves of bread, but the same number of loaves of bread each year, and the same amount of car services each year. So I'm sorry, I didn't say, we're predicting that there's going to be 2% inflation over that period of time, 2% each year. So that means that $75,000 in 2023 would be $91,000 in 2033, 111,000, 2043, all the way up to 166,000, 40 yes, 40 years from now. So if we're going to fund this, we need investments that will help us fund it. But before we look at those investments, let's recognize that inflation might or might not follow the path that we expect. If you think back to the graph I showed you earlier on how inflation had behaved since 1915 or something, you remember that inflation was pretty steady from 1985 to 2020 or so, and then it increased very rapidly and unexpectedly. So it can also be the case that while we plan for and predict, and we might get 2% inflation every year, and if we do, then this is how the amount of money that we need will change from 75,000 to 91,000 over the next 10 years. But it might be that inflation changes differently. And we're going to use as an example planning for 2%, but we might get 4% for the next 5 years and then 0% for the 5 years after that. And if we do that, if that happens, then you see that the amount of money that we need in dollars will be higher all the time than what we expected, even though the average over the whole period works out to be the same. 4% for 5 years and 0 for 5 years turns out to be about the same as 2% every year for 10 years. So that could be a problem, because if we plan for this and we get this, we need an investment that will react and respond and help us have the purchasing power that we need in dollar terms. So let's think about CDs as a potential investment here. So CDs are like savings accounts with restrictions. You can't take money out before they mature. There are often penalties for early withdrawal. The interest rate is fixed, and interest is added to the principal. So there's compounding. So as an example here, we're looking at an interest rate of 4%. And we see that if we buy a $1,000 CD, in the first year, we're going to get $40 of interest. And then at the end of that 12 months, we'll have 1,040. But then the next year, we'll get 4% of 1,040, and we'll get a little bit more interest and a little bit more each year subsequently. So that at the end, we'll have $1,217 for our $1,000 investment. Excuse me. So suppose that we're going to fund future spending with a CD, and you might remember that, I didn't show you, but we'll see that if we were getting 2% inflation each year, then we'd need $83,000 in 2028 to buy as much as $75,000 would in 2023, and that's the purchasing power we need. So. And I picked 2028 because it's halfway between 2023 and 2033. So if CDs are paying 4%, how much CD do we need to buy in 2023 to fund this $83,000? Now, I'll bet you're saying, this is one of those word problems that we had in maybe high school. We weren't that fond of those. Solve for X. X is how much CD should we buy? But with CDs, because it's the same interest rate every year, it's pretty easy to do. And I've laid out here the sequence of arithmetic that you have to do to figure it out. And the answer is $68,000. If we put in $68,220, if we buy a CD for $68,220 in 2023, and it pays 4%, in 2028, we'll have $83,000. So let's plan to fund the whole of the next 10 years with CDs. And we saw that if in 2028, remember we started at 75,000 in 2023, and we ended with 91,000 in 2033. And here are all the intermediate numbers, all in thousands of dollars. And what we've done, or what I've done, is to say, how much do we need to buy in CDs each year to be able to have this amount in each of these years? So in particular, how much CD do we need to buy in 2023 to have 83,000 in 2028? The answer is 68,000, remember. So, and then I've done that for all of these years. So how does that work? Well, it works very well if we get the inflation that we expected, right? With the inflation that we expected, these are the right numbers, and this is how much we'll have. It matches perfectly. But suppose that instead we get the inflation pattern that I suggested second, which is the higher uh, inflation rate early on and zero later. And then, even though CDs are paying 4%, because inflation is 4% for 5 years instead of 2, and 0% for the following 5, funding each year's actual spending with the CD is going to leave us short. And in particular, in 2028, while we thought we were going to need 83,000, in fact, we need 91,000, and we're short. The CDs leave us short fundamentally because they don't respond to inflation. Their interest rate does not change. If we knew that inflation was going to be higher, we would have put more money in our CDs, but we didn't know that. So we end up short. And that's a problem for us as we plan our retirements. And we would really like to be able to plan retirement and be sure that we have enough when we get there. Okay, now, and I'm going to just illustrate what I just showed you. CD funding works well if we can predict inflation, right? Because here's our planned need in the gray, and here's the CD maturity values in green. They line up perfectly. So CDs work if we can predict inflation. But if inflation is faster than we expected, then we're short. And we're short every year in this example. Now, if inflation is slower than we expect, then CDs will provide extra. But as a planner, I'm more concerned with being short than I am with having too much. I'd love to be pleasantly surprised. We're really unhappy if we're unpleasantly surprised. So the question is, what can we do? What other choices do we have besides CDs? And Carrie, I think now is a good place to stop and take questions.
Okay. So let's see if I can find the questions. We don't seem to have a ton of questions right now.
We don't have to have questions. I can move forward.
Yeah. I think some people are asking stuff that I think maybe are more personal, and we can handle like that.
Okay. All right. When we buy a bond or a CD, we're lending our money, and we expect to get our money back, and also we expect to be paid for not having the use of our money. And this extra payment is called interest. And the larger that extra payment, the higher the interest rate. And that interest rate is expressed as a rate or percentage of the principal. When we lend in dollars, the interest is paid in dollars. The rate is a percentage of dollars, the extra payment divided by dollars of principal. Now, so here's just writing that out. if we lend out $1,000 and the interest rate is 2%, we're going to get back the $1,000, and we're going to get $20 of interest back, which is 2% of the 1,000. So the borrower is paying back the 1,000 plus the $20, and we're going to have 1,020, principal plus interest. We're most interested, however, in what our dollars will buy, in their buying power. So here we're expressing principal and interest in loaves of bread, in stuff that we might buy. We can't actually make loans with our bread, it might get moldy. But the idea is we're trying to get payments in purchasing power terms, in what we can buy. So I'd like us to think about our loans in buying power terms. So with the rate of inflation, we can do that. We can think about a real interest rate, an interest rate in buying power terms. And if we lend $1,000 for a year at 2%, again, we've got the $1,000 in principal, the $20 in interest, and this is what the borrower is going to repay. But if there's inflation, and I'm suggesting here that there's 4% inflation, the inflation steals some of that value, and in buying power, we have only $980. So we get the $1,000 of principal plus the $20 of interest, but then we lose $40 to inflation. And so this is what we get back. We've got less buying power than we hoped for because inflation is that silent thief of value. Now, the nominal or the dollar interest rate is still 2%, but that real or purchasing power interest rate is minus 2%. And it turns out that there's a simple relationship between nominal interest, real interest, and inflation. And that is this, that the real interest rate plus the inflation rate is the nominal rate. Or alternatively, the real rate is the nominal rate minus inflation. And it's the real rate that tells us how much return we're getting in purchasing power terms, how much stuff we're going to be able to buy with our money after the loan is repaid. Now, you might ask, well, where does that buying power that's lost to inflation go? And inflation, you can see the text on the chart. The idea is that the borrower gets the extra buying power because they don't have to pay the full amount of buying power that they thought they were going to have to. So imagine that you had borrowed money, say on a mortgage in 2003, and you're still paying principal today. Well, the dollars that you're paying in today are worth only 60 cents versus dollars of 2003. So you're paying back in cheaper dollars than you borrowed. And you can think of it in terms of bread too, right? In 2003, that each dollar you borrowed would buy one pound loaf of bread, and the dollars that you're paying back today would buy only half of a 1 pound loaf of bread. So that's who benefits, right? Because you've gotten if you're the borrower, you've gotten the benefit of paying back in cheaper dollars. But we're thinking about this from the perspective of the lender, and as lenders, we don't like getting paid back in cheaper dollars, and if we plan to get paid in full value dollars and we get paid back in cheaper dollars, then we're not going to be able to buy all the things that we're planning to buy after we retire or when we're paying for college for our kids. So how do you protect your investments against inflation, and in particular against surprise inflation, right? Because the CDs worked okay when inflation was what we predicted. And the answer is we'd like to lend in buying power terms rather than in dollar terms. And we can't lend bread, we can't lend Corollas, right? But there are two government-issued investments that borrow in buying power terms. And those are TIPS, Treasury Inflation-Protected Securities, and I bonds. And so we're going to talk about those. And I'm going to, at this point, and I'll talk a little bit more about TIPS here. TIPS are Treasury bonds where the face amount adjusts to replace inflation. And I bonds are savings bonds where the interest rate increases so that the total interest rate, the nominal interest rate, is the real interest rate plus inflation. So TIPS and I bonds adjust differently for inflation, but they both do. Now, I'm going to emphasize that this webinar is for beginners, right? So we're going to leave out variations in inflation, we're going to leave out taxes, we're going to leave out other special characteristics of TIPS and I bonds that I think are a distraction from the fundamentals of how TIPS and I bonds work. And we're going to focus on those for the rest of the discussion. Let's start with TIPS. And let's start with how TIPS work. They're bonds, they're issued in multiple maturities, and they're long in terms of maturity, right? 5, 10, and 30 years. The real interest rate on these bonds is set when they're issued, and they're set in the market by auction. So we're very confident that the interest rate that's set on the TIPS at the time of issue is the real interest rate that's expected over the term of the bond, because it's agreed by all the buyers. In effect, the buyers insist that they're going to pay only so much for the bonds so that they get the real interest rate. TIPS respond to inflation by adjusting their face amount in proportion to inflation, and TIPS trade in the market, so their prices can rise and fall as real interest rates fall and rise. And in a previous webinar, we talked about interest rates and bond prices and how they move in opposite directions. And if you have questions about that, we can refer you to the appropriate webinar. Now let's look at the example here and see how that plays out. So we buy $1,000 TIPS in early 2023. And for the purposes of our example, we're going to assume that the real interest rate is 2%, inflation is 4%, and that means that the nominal interest rate is 6%, right? The real interest rate plus the inflation rate. Okay, so between 2023 and 2024, inflation 4%, 4% of 1,000 is $40, and the face amount adjusts to 1,040. The bond also pays 2% or $20 in interest. So the total increase here in value that we get is 6%, $60. Now, as we go to the next year, again, we've got 4% inflation. The face amount adjusts by another 4%. And we get interest now on the 1,040, not on the 1,000. So we get $21 of interest. And I'm going to add in here, and this is something that we want to pay careful attention to, I'm going to add in here interest on the interest, because the question is, given these interest payments, what are we doing with them? We could just hold them in cash, but that wouldn't be very efficient of us as investors. So we're going to reinvest the interest. And to make the numbers easy, I'm going to assume that we can reinvest this interest, excuse me, on the same terms as we made the initial investment. And if we do that, then the total return that we get in the second year is the $42 face adjustment plus the $21 interest payment plus the interest on the interest, which is $1, and that's 64. Okay, and we keep going, and at the end, to find out how much return we've gotten, we look at the face amount of the bond when it matures, if it's a 5-year bond, plus the interest that we've gotten, plus the interest on the interest. So the cumulative total is this face amount plus the total of the interest plus the total of the interest on the interest. This is 121 plus the 1217, that's $1,338. So that's TIPS. That's how TIPS work. Now let's think about I bonds. I bonds are like savings accounts or with restrictions. So when you put the money in, you can't take it out for a year. And if you take the money out before 5 years elapse, then there's a 3-month interest penalty. So if you took it out after a year, you'd get 9 months of interest. If you took it out after 2 years, you'd get 1 year and 9 months of interest, and so forth. And the interest rate is a nominal rate, and it adjusts for inflation. So it starts with a real interest rate that's set for each I bond when it's issued, and then it adds inflation. And in this case, we're going to make it comparable, we're going to assume that the real interest rate is 2% and the inflation rate is 4. So the nominal rate is going to be 6, 2 plus 4, again, just as with the TIPS. And here, what's going to happen is we're going to take the $1,000 that we started with, we're going to get 6% interest, that's going to be added to the face amount. And that's going to continue throughout the 5 years, and we're going to end up with $1,338. That may be a familiar number. Because if we compare the two, in this example, which abstracts, remember, from a lot of potential issues, but in principle, the returns are the same, even though the mechanism is different, right? Because the TIPS has a real interest rate, but adjusts the face amount for inflation. And the I bond has a nominal interest rate that's equal to the real interest rate plus the rate of inflation. Turns out it works the same. So you see that the totals here, the total change in, or the total value of the investment is the same. And we see that each year, the total increase is the same, even though the mechanisms are different. So both TIPS and I bonds help us keep up with inflation. Okay, so now let's go back to our problem, right? Which is that we're trying to fund future spending, and we're doing that in an environment where inflation's not predictable. And we're going to invest the same amount in TIPS that we invested in CDs before. So the numbers in this column, the amount that we buy of CDs or TIPS is the amount of CDs that we decided we would buy way back in the first part of the discussion. And notice that while the CD maturity value is $83,000 in 2028, which is the amount of the planned need, that the TIPS matures at $91,000, which is the amount that we need with the higher inflation that we didn't expect. So we invested in the TIPS just as we invested in the CDs. Remember that we'd have to reinvest the interest from the TIPS to get the full value, but the TIPS adjust for inflation. So the TIPS produce exactly the amount we need each year. And that's in contrast with the CD performance, which has shortfalls when inflation is larger than we expect. So if we look at TIPS and I bonds against CDs, right, in the same graph now, so this is the forecast with 2%. This is what we actually need with 4% inflation and then 0% inflation. The CDs give you exactly what we expected, and the TIPS and the I bonds give us exactly what we need. So the TIPS and the I bonds solve this problem of how to invest if we get it to protect us from unanticipated inflation. So both TIPS and I bonds deliver the real returns, the purchasing power, the buying power returns that we need in order to be able to accomplish our plan. And they do that because they both deliver real returns, buying power returns. Their nominal return increases so that the real return matches, the nominal return increases to match inflation. So the TIPS do that by adjusting the face amount. The I bonds do that by adjusting the interest rate. Their performance is equivalent. So both of these investments help us protect ourselves against unexpected inflation. And that's very valuable. These are the only investments that do that in a predictable way. TIPS and I bonds are different from each other. TIPS are market tradable and often long-term bonds. Their market price varies inversely with real interest rates. They pay interest in cash, which means that we have reinvestment risk. The reinvestment risk is that we might not be able to reinvest the interest at the same rate as the bond is paying. But they're very flexible. You can buy as much as you want. There's no limit. I bonds are savings bonds. Their principal is protected in real terms, which is true of TIPS only at maturity. I bonds have early withdrawal penalties and restrictions on withdrawals for the first year, and you can buy only limited amounts, $10,000 per year per person. So if we really wanted to fund the spending that we were talking about in our example, where we need $75,000 a year of purchasing power, it would take a long time to buy that much in terms of I bonds. So the TIPS are going to be more effective in real world planning situations. So what are they good for? What can you use these for? The different features of I bonds and TIPS mean that they're not perfect substitutes for each other. TIPS are typically better for longer term and specific objectives, like the example that we've just worked through, where we have a certain amount of spending that we want to do each year. The TIPS allow us to identify, the TIPS allow us to lock in that amount of purchasing power at a specified date, or at a series of specified dates, because you can build what's called the ladder of TIPS to fund each year of spending in the future. I bonds are good for uncertain term and uncertain amount objectives, like maybe an emergency fund where you'd like to have a certain amount of purchasing power available to you, or you're thinking about funding college, or you're thinking about funding a down payment on a house, and you don't know exactly how much you need, but you want to be sure that you preserve the purchasing power of whatever money you set aside. That is TIPS and I bonds for beginners. At this point, we'll take some questions.
One of the questions was from Joseph. He was wondering, these numbers are the numbers that you use for the examples. Are these are before tax? These
numbers are all before tax.
Okay.
That's right, including the CD returns, by the way.
Okay.
Right. So, and again, since this is for beginners, we're leaving out a lot of complications.
Right.
But yes, you have to consider taxes.
Okay. Also, someone asked for you to give us the formula again for nominal rate and real rate.
Sure. Here. So the real rate equals the nominal rate minus inflation. This is actually an equation that was developed by an economist named Irving Fisher, who was active during and after the Great Depression. He was a very fine economist, and he developed this relationship.
Okay, great. Someone just needed that clarified. Okay, so another person asks, do you purchase TIPS as an ETF or mutual fund, or is it best to buy individual bonds? What is the best method?
That's an excellent question. Just as with any traded bond, you can buy them either individually or in a mutual fund. Buying them in a mutual fund is a way to invest in bonds without a target date. When you buy a mutual fund, the mutual fund buys bonds of multiple maturities, typically, and then as the bonds mature, they take the return of principal and invest in new bonds. So your bond mutual fund never matures, but it provides income. Primarily, the income that you get is from the coupon payments on the bonds, and then the price of the bond fund will change depending on how interest rates change. And all of us lived through 2022, and we all lived through interest rates rising and bond mutual fund prices falling. And that is an issue with buying mutual funds or buying bonds in mutual funds. If you're targeting spending at a particular date and you have to sell the bond fund in order to make your purchases, then you run the risk of having to sell your bond fund after interest rates have risen and after the price has fallen. If you buy individual bonds and you purchase them to mature at the time that you need the money, then it doesn't matter what interest rates do in the interim. You will have the purchasing power at the maturity date that you expected. And so if you're planning to fund specific spending in a specific year, then individual bonds are better. But individual bonds are harder to buy and harder to keep track of than mutual funds, right? You can buy a TIPS mutual fund, you have one position. But if you buy a TIPS ladder, let's say for 25 years, you're going to have 25 positions that you have to keep track of. So that's the trade-off. But for the purposes of this discussion, we were talking about, I'm sorry, let me go this way. Here we're talking about, in this case, we're talking about buying a bond of different maturities for each year. So this would be a 1-year bond in 2023, 2 years, 3 years, 4, 5, and so forth. Right? So in the example, we're buying individual bonds that mature at the date where we need the buying power.
Okay. So let's see. Someone asked, are you saying that if we build a TIPS ladder, the interest on interest is automatically reinvested?
It is. Go ahead. I'm sorry.
Oh, sorry. Or do we have to separately invest the interest on interest? And if such separate reinvestment is required, do we invest funds outside of the TIPS ladder to get this interest on interest?
That is an excellent question. Again, this is for beginners, but when we build a TIPS ladder, we include the interest as part of the funds that arrive each year, right? So if we suppose that we are buying a TIPS ladder to cover this 10-year period here, from 2024 to 2033, and we're going to buy. The way we've done the example, we've said the money that the proceeds of this bond are going to fund spending in this year. But in practice, what we do is to recognize that this bond is going to pay interest in 2024. And so we can plan to spend that interest in 2024, and we can buy a little bit less of the bond that's going to mature in 2024 because we don't need quite as much principal because we're going to have interest from all of these bonds. Does
Oh,
that make sense? So these bonds all pay interest every year. So the bond that we buy in that will mature in 2025 is going to pay interest in 2024. So we can include that interest as part of the money that's going to support this spending here. And we can include interest from all these bonds that are going to mature later to help support that spending, because they're going to arrive that year. And then we don't have to reinvest. We just count it as part of the money that we can spend that year. But let me try one more time. Suppose that we didn't buy any bonds except bonds in 2033. They're going to mature in 2033. We don't buy any of these bonds. We're going to buy a lot of bonds that are going to mature in 2033, so that there will be a lot of interest. There'll be enough interest in 2024 that we can support the spending. Then we don't have to reinvest that interest because we're going to spend it. And it will also pay interest in 2025. And we'll spend that interest too. So you can either reinvest the interest, which is more complicated, or you can plan the TIPS ladder so that the interest supports your spending. And that's much less complicated. It's more complicated to figure out in the first place, but it's much less complicated to manage, because we don't have to reinvest the interest. It's arriving when we need it to spend.
okay, we do have another question. Let's see. Some of them you answered in your previous answers. So Jason asks, the fact that TIPS face value decreases when interest rates rise seems to make it less useful as a place to hold an emergency fund.
Okay, so there's a difference between face value and price. So the face value increases with inflation, and the face value does not change with interest rates. So interest rates could rise, the price could fall, but the face value will not fall. And that's a complexity of all bonds. Even a traditional bond where the face value doesn't change, the price will fall if interest rates rise. So the face value tells us what will be repaid by the borrower when the bond matures. The price tells us how much the stream of interest payments plus that principal payment at the end is worth in the market, how much people will pay for that stream of interest payments and the final payment of principal. And if interest rates rise, that stream of payments is worth less, because if I buy another bond with higher interest rates, I'll get higher payments. So in order to hold the bond with the lower interest rate, I'm only willing to if you want me to hold that, I'm going to pay less for it, because it's not worth as much to me, because I can get more from a bond that's newly issued. But in terms of the payments that I'm expecting, I'm going to get what I expect when that TIPS matures, regardless of what happens to interest rates in the interim, because the promise to pay is based on the face value, which adjusts with inflation.
Okay. Mark asks, if you're buying individual TIPS bonds, where are good places to buy them?
There are fundamentally two places to buy individual TIPS. You can buy them at auction, and you can do that at treasurydirect.gov. You can set up an account at treasurydirect.gov and buy your bonds there. Or you can buy them in a brokerage account, and an IRA can have a brokerage account in it. And there you can either buy them at auction again using your brokerage account, or you can buy them on the open market And the advantage to buying them on the open market is that you can buy any maturity, whereas the bonds that you buy at auction or through Treasury Direct are going to be available only on the fives, right? So you can get a 5-year bond, a 10-year bond, a 30-year bond. Sometimes you can get 20 years because they'll reopen a 30-year bond after 10 years so that you can buy them the remaining 20 years on those bonds. But if you want to buy a 3-year bond, you cannot do that at auction. You have to buy that on the open market. And the disadvantage of buying on the open market is that you're buying, you're accessing the market, and it's not free. People don't participate in the market just for the joy of it. They expect to be paid, and so you're going to pay a little bit of a transaction cost, or a little bit of a difference between the price that people are willing to accept when they sell and the price that they're willing to pay when they buy. So that difference, that margin, goes to the people that are making the market, and so it costs you a little.
I'm going to ask one last question, and it was, where is it? Is there such a thing as a Roth TIPS or I bonds, or maybe, or is the
So that there are not bonds that are specific to Roth IRAs, but you can buy TIPS in a Roth IRA, and you can buy any kind of an account that you can set up at Treasury Direct. You can use to buy TIPS, and you can use to buy I bonds. And any type of account, any type of brokerage account that you have, you can use to buy TIPS. You can buy I bonds only at Treasury Direct, or there's one other way to get TIPS. I'm sorry, I bonds. You can overpay your federal income tax and then ask to have the refund sent to you in terms of I bonds, and you can get up to $5,000 a year that way.
That's interesting. I think that's all we have time for.
Okay, so
today.
let's close out. I've got to get to the end.
And just to let people know who did have questions and who did make these comments, everyone is going to receive this entire webinar, a link to it in your email, everyone who registered, so that you'll be able to go back and look at it later if there's something you really want to check out.
And we will look through the questions and see if there are any that we didn't somehow get to, and I will respond to the whole group with answers to those questions. Okay, so summing up, inflation steals your purchasing power or buying power. Real interest rates, buying power interest rates, are lower than nominal interest rates by the rate of inflation. So the real interest rate equals the nominal rate minus the rate of inflation. Both TIPS and I bonds are US government issued inflation-protected bonds. They adjust for inflation differently, but the end result is the same. Both protect your purchasing power. TIPS are better for specific long-term objectives, and I bonds are better as savings account and CD substitutes. So that concludes today's webinar. In October, the next webinar will be about the ABCs and Ds of Medicare. That will be on October 26th. And then in November, we'll have a webinar on managing money as a couple, thinking about marriage, and that will be November 21st. We'll hope to see you then. Thanks for coming. Have a good